Have you ever stopped to think about how many decisions are involved in buying a new car? You must decide on the make of the car, the model of the car, and the color of the car. Plus, you need to determine if you want leather or cloth interior, a two-wheel or four-wheel drive, and even if you want a new or a used car. By the time you read up on the safety, performance, and maintenance facts of each car, then read the reviews from the experts, mechanics, and consumers who own those cars, you can easily spend several weeks or even months shopping for the right car. Yet, with all the time that is spent in selecting just the right vehicle, most people spend the least amount of time on the one thing that can have the greatest impact of all: automobile financing. You see, when it comes to financing, most people focus on two things when they buy a car: price and interest rate. Yet, even if you get a car loan at just 8.5% APR, 25% of your car payments will go toward interest. When you consider the number of cars you will purchase in your lifetime, that's a ton of money. Let's assume you'll buy a new car every 4 years for the next 44 years, so 11 cars total. Each car will be financed for $10,550 and can be financed at 8.5% interest for 48 months. You have a choice with how to pay for these cars. You can use one of 5 methods. You can buy them through a bank or other finance company, lease them, pay cash for them, use an interest-earning savings account, or use your own bank by using the Infinite Banking System. Let's look at each method in further detail. Buying the car through a bank at 8.5% interest would cost $260 per month, which is $3,030 per year. Over 44 years, that amounts to $137,280. Leasing a car costs a little bit more. Why? Because you lease from the owner of the car. Is the owner a fool? No. He will make some money on the activity. Let's then assume that leasing will cost you $175,000. Paying cash for the car will first require you to save up for the car, so you would have to defer buying the first car for 4 years. The overall cost for the cars would be $116,050, which is the $10,550 times 11 cars. The last two methods both involve having a banking mentality. The difference is using your own bank versus using someone else's. Let's compare. Assume for the last two methods you understand the need to capitalize your bank, so you accumulate $5,000 per year for 7 years before purchasing the first car. You could accumulate your money in a savings account and buy certificates of deposit at someone else's bank in the amount of $5,000 with a yield of 5.5% interest. However, this interest is taxable, so the after-tax effect is 4%, assuming a 30% tax bracket. After 7 years, you would have $41,071 in your account. So, you buy your first car and continue to make the $3,030 car payments into your savings accounts. By year 50, you would have $258,927 in this account. Alternatively, you could accumulate your money in a dividend-paying permanent life insurance policy instead of at someone else's bank. For the first 14 years, putting your money in someone else's bank comes out ahead. But from that point forward, the infinite banking concept is favored in an accelerating fashion. In fact, by year 50, you will have $964,638. That's $705,710 more than putting your money in someone else's bank. Why is this? Because when you become your own banker, you are the only owner of your bank, so you receive the profits that would otherwise go to the bank. It's that simple and that powerful. There really is no comparison. So, congratulations once again on your decision to become your own banker. You will soon be in a position to stop supporting the employees and shareholders of other banks and finance companies through all of the interest you're paying to them, and instead use that money to support you and your family. You'll soon discover that becoming your own banker will prove to be one of the wisest decisions of your lifetime.